Hey everybody, and welcome to this month's Schedule CE. Now this is supposed to be November's, and life happened and it's December's, so I tried to make up for it by doing a topic that was in-depth enough and a little bit different than the stuff we've previously talked about to make up for it being 2 months worth of material. Now, as usual, my name is Patrick Moore. I'm the owner and founder of Ironclad Wealth Management. And I wanted to, thank you for taking the time to go over this. Now, there is an accompanying blog for this, so if you want to read through this, feel free to. But this is a video, and what we're going to do today is we're going to go over some of the key points of the blog and go over what disability insurance is, why it matters, and what it's protecting. It's pretty straightforward, but there's so many little nuances, so many little definitions when you talk about an insurance company that I wanted to make sure that nothing got lost in the wash. Now, the good part is I'm actually going to pull up an example of my financial planning software too, so you can see how I think about it. And I'm also going to pull up an insurance quote so you can see what it looks like and we can see some of the key terms as we go through it. Now, first things first, the key thing to know is none of this is individualized specific advice. Okay? This is general educational information. If you do think it'll apply to you, research your own situation. Feel free to reach out to me and I can help answer questions outside of this once there's a little bit more context. Now, I think the important thing to understand when we look at disability insurance is not to say, oh, you need a disability insurance policy, right? That the question becomes, what's the problem, right? What is the risk that we are trying to insure? And are there other solutions than just buying an insurance policy? And the risk that I'm talking about today is what happens if your income stops. It could be due to an accident. It could be due to sickness. Really, it's things that are outside of your control. Okay? And today, we're all going to be Joe Sample. And for the ladies on the call, Josephine Sample. Okay? The example that I've done, because I wanted to show you what this looks like in my actual planning software, is I took a real quote of a male, age 45. So the numbers would be a little bit different for women, but just for purposes of kind of keeping things concise, I did use a male, age 45, self-employed, earning $500,000 a year, and as part of his financial plan, because remember, the disability insurance, the protection we're doing, all has to be downstream of the plan. It doesn't make sense to do one and just kind of do it on your own. It has to integrate into that plan. And he's saving $200,000 each year because at 55, he might want to retire with like $2.5, $3 million, whatever that investment account grows to. So when we talk about protecting that plan, there's really three key options, okay? Really, it's kind of a two and one has a subset. The first and best option is to be self-insured, okay? And that's pretty self-explanatory, but essentially that aligns with being financially free, not needing to work. And most people under the age of 45, and in this case, if we think about this person who went out, started his own practice, he doesn't have the cash to be financially free. That's what he's working towards. That's why he took that chance. He probably invested a bunch of his money in his business to get it started. Now he's making a lot and he wants to catch up on that saving. Well, you can be self-insured. That's great, but it's more of a goal. Okay, it's more of like that's the actual end point of your plan. So if you're 55, if you're 60, or if you're 45 and you have a couple $1 million in your investment accounts, you're probably self-insured. You would just need to analyze that and figure out if that's the case. Now, something that people typically mix up, what I'm talking about today, is they think that their emergency fund is self-insurance, okay? And the reason why it's not is an emergency fund is really only designed to last for 3 to 6 months. When I'm talking about your income stopping and that having a detrimental effect on your plan, your outlook, and really your life, I'm talking about something that means this client's age 45, he won't be able to work until age 65, until age 67, when he was planning to retire in the first place. A long-term event where you're unable to work. An emergency fund is necessary, and it's necessary before even disability insurance. You got to be able to pay for that HVAC unit if it goes out, but it's not self-insurance. So really, it's not going to last long-term enough to handle a long-term disability event. A short-term disability event, yes. Long-term, no. And then the final option that we have is we do have insurance, okay? That's the act of not self-insuring and transferring the risk to an insurance company. You pay them money, they take care of the risk, okay? So those are the three main options that we're going to look at today. Now, what I want to go over, because I think the first two are very self-explanatory, right? It's just having enough money in the event something bad happens. Disability insurance has so many kind of tips, tricks, nooks, crannies of definitions that this is the complicated one, and that's what we're going to do our deep dive on today. Now, what I've done is I have also run an actual quote. What I'm assuming is that Joe Sample is an attorney. Could be an engineer, could be an accountant. All these have slightly different definitions, but I'm kind of thinking of somebody who's a service professional, started their own firm, working on their own, and is in the act of trading their time for money. And they are potentially unable to continue to do that. So one of the companies I ran this with was Principal, and so we're going to contrast some of the generic definitions that insurance companies use and what Principal does, okay? So this is just an example of it. We'll really get into it in just a moment. But we're going to go over how it works, okay? And the main thing that we need to understand, and the first question that I always get asked when it comes to disability insurance is, how does it pay me when I can no longer work? Okay, so there's obviously the prerequisite there that your work is affected, okay? But what these insurance companies are going to do is they are going in the contract to have a definition of disability, okay? The first thing that we need to follow is on the left here, and that is in the event you are totally disabled, okay? If you're totally disabled, your contract will specify whether it's an own occupation or an any occupation definition of disability. In an own occupation definition of disability, the insurance company is going to state that they will pay you if you can no longer do the duties of your job and your occupation. So in this case, if the lawyer can't run, own, operate his own firm, if he can't do the client work necessary, he would receive disability benefits. Now, the second option is an any occupation benefit. And the difference here is that an any occupation benefit means that you are unable, it will only pay you if you are unable to do any job that you are reasonably qualified for by education or experience. Okay? In this example, let's say that for some reason Joe can't own and operate his own firm. It's just too demanding for his health, things like that. But he could still go back to a large law firm, or maybe go back and do some sort of paralegal work, things like that. Well, under any occupation benefit, you're really kind of leaving yourself open to the interpretations of the insurance carrier. And really what this tells me is, A, it's not a place you want to be if you're sick, if you're hurt, if you're unable to work, okay? So when I'm thinking about what's best, one of the first things you want to look for in your contracts is an own occupation definition of disability. Now, some contracts too, and this is very common in workplace contracts, so things you may have had when you weren't on your own, when you were, kind of working at a large firm, whatever kind of firm that may be. A lot of times what they'll do is they'll say, hey, you can have an own occupation benefit for 2 years, and then it shifts to an any occupation benefit. So you'll want to really analyze those definitions and see what works. And we'll look at principles here in just a second. Now, the second way you can get paid is through partial disability, okay? And this is very straightforward, right? What can you do if you're unable to do everything you used to do? And this one's a little hit or miss. Sometimes companies will have varying definitions of this, but it's really important, okay? Because unlike total disability, partial disability will typically kick in if your earnings go down by about 20%. And you're unable to kind of do everything you used to. So let's say, for example, Joe has a form of cancer, okay? And let's say that 2 days a week, or maybe 1 week a month, he has chemo and he's unable to go back into the job and do what he's doing. Well, that's going to be somewhere between 25% and 40% of average days lost. So it makes sense that since he's trading time for money, he's going to be unable to essentially, make as much as he used to. So that's step one. And then he's also going to be unable to keep the hours that he used to keep as well. So that's going to be where a partial disability clause kicks in, and it will pay you proportional to your benefits. So if you lose 20% of your earnings, it'll give you a 20% benefit. 50% 50, 80% 80. Sometimes they'll have a clause in there where if you do go down 75 or 80, they'll just pay you the whole thing anyway. But that's going to change company by company. So let's look at how Principal does it. And I work with, a bunch of different insurance companies. So this is just one that Principal's got it really solid, kind of like white collar insurance. So that's why I chose them. Not trying to show Principal in any way. Just a good kind of learning opportunity. So if we look at this for Principal, you can kind of see their quote, blah, blah, blah. Really not too much for us to look at on this first page. But where things start to get interesting is it starts to get interesting where you can see the definitions of disability on this page here. So if we look here, you'll see that a monthly benefit of $16,000 gets paid if you're unable to work. And total disability means you must be unable to perform the substantial and material duties of your occupation and you are not working. So this is an own occupation benefit. Okay, so that's key number one. That's a good thing. But the second thing you'll see here is it says, and you are not working. So what this is telling us is it's saying that, hey, if you're unable to do your job, you can't go get another one, or those benefits stop. Now, something that we actually added on to this rider that not every company, or this policy that not every company will do, is something a little bit different. Let me find it. And it is a regular occupation rider. So not only is it an own occupation rider, it has something called a regular occupation rider on it, which says, if you become totally disabled from your regular occupation and choose to work, keyword being choose, not being forced to, you receive full benefits regardless of the income you earn from the other occupation. So in this example, Joe could be unable to be a lawyer, take those disability benefits, start a new venture, do something else, and not be affected and still get that full income he was expecting to get. So those are both pluses in the Principal contract, and that's something that when you look at other companies, they might have different words. Like I've seen some call it a transitional occupation rider, or maybe pay you while you kind of get ready for another occupation. Some call it, an enhanced rider. They're all going to have their own little terms, but now that you know what to look for, you can hopefully find one that's right for you. Now here's where the terms get a little different too. Is Principal has what they call a residual disability and recovery benefit rider. That is their partial benefit rider, because you can see that what it says, if you lose at least 20% of your prior earnings and you're unable to perform some of your duties or work full time, you would qualify for those benefits. So you can see that we can actually follow just like we just talked about. And when you review these, you can actually see where this is looking. Okay, kind of see this in the quotes yourself. And when you look at a quote for yourself, whether it's Principal, Mass Mutual, Guardian, Standard, Assurity, Illinois Mutual, there's a lot of carriers out there who do this. If you go in and always ask for more than one, try and compare. Try and see which one gives you the best definition. So just to kind of summarize here, when we're talking about definitions of disability, and once again, this is all on the blog too, own occupation is best, and you want to make sure that your disability policy has a partial clause in there, because not all of them do. Now, the next question that I typically get is how much is the benefit? Okay? Typically, disability insurance is going to pay you somewhere between 60 and 70% maximum of your income for disability insurance. Now, one of the things that you will notice on Joe's policy here is that it is 60% maximum, but it caps out for Principal at $16,000 a month, which is only 38% of Joe's income. Now, that's because most insurance companies are going to have a maximum they can do for each person's life. So what you can do is you can get your baseline, which would be a Principal policy, $16,000 a month, And then you can either just say, hey, Patrick, or whoever your agent is or advisor is, hey, that's enough for me. If something happens, I can cut some costs, cut some expenses, I'll be fine. And then what you can do is say, okay, well, I'll just stay with the 16,000. If you do want to insure your full income, you can layer on another policy on top and actually get a supplemental policy that'll help you get a little bit more. Now, you may be saying, hey, if I can only get 60% of my income, that's not going to be enough. I make $500,000. How does this work? Well, what I did is I ran an example that shows you why this works. Okay? This is a single LLC owner. Let's say Joe was located in Georgia, which is where I am. So, fancy how that works. If you look at this, while you're working, I ran this through just a very basic tax quoter. Your income at $500,000 would have about taxes of almost $200,000 and would leave you with a little more than $300,000 in annual income. But if you look over there on the right, if you're disabled and you have the policies for the full $300,000, you'll notice a big gaping blank spot on the taxes. Okay? And that's because disability benefits, if they're structured properly, so that's always the if you got to throw in there, are tax-free. Okay? And so within these Georgia tax rates, if Joe Sample has a $300,000 or Josephine Sample has $300,000 of benefits coming in each year, he or she would be almost dead even with where they were while they were still working. So one of the reasons that they'll cap you at 60% of benefits is because they know you're not going to pay taxes on that, which really gets you close to 100% replacement, because they don't want you to make more money while you're out than if you were working. And I know that the business owner in me, the business owner in you is going to say, well, Patrick, is that a business expense? Can I deduct those disability insurance premiums? This is maybe one of the most important things on this, is that you can't have your cake and eat it too. Okay? If you deduct, and you can, if you deduct your premiums, all of the sudden, this becomes taxable. Okay? And instead of having 60% income replacement, you may only have 40% income replacement. So one of the key things I want you to know is that personally, I don't think deducting those premiums as a business expense makes sense, because it makes your benefits taxable. Whereas vice versa, if you don't deduct your premiums, all of the benefits are tax-free. So that's going to be something that I think is really important for you to make your own informed decision on. You can say, hey, I'm guaranteed to pay premiums. Let me get those deductions. I'm not guaranteed to be disabled. However, disability is 3 times as likely as death. And it's going to be something where I kind of feel like you're kind of picking up pennies in front of a freight train, right? You're like, hey, if I spend a few $1,000s, I don't get a deduction on it. It is what it is. But if all of a sudden a couple $100,000 of benefits in the future are taxable, you're really kind of shortchanging yourself in the future. So that's definitely something to consider, as you think about your tax decisions here. Now, the next question and the next area of disability coverage is, kind of how long does the policy last? Okay? And this is going to be something that's really up to you, up to a certain extent. There are 2 key, we'll call them time periods, that matter in a disability policy. The first is the waiting period, which is going to be known in disability policies as an elimination period. Okay? The average policy is 90 days. Okay? The average long-term policy. Some short-term policies will be immediate, but they only pay for 3 months. The benefit period is going to be how long they pay you. Okay? And those are going to be anywhere from 90 days all the way to when you were supposed to retire at age 67. Now, what you can see here on this one is that we have a benefit period to age 67 for good old Joe Sample, to start 90 days and start day 91 and pay him to age 67. Basically saying, hey, just replace my income if something happens to me for as long as I could have worked in the first place. But one of the things we could think about is we could say, okay, well, what if, Joe was only planning to work for another 10 more years? Well, you could shave that benefit period down to a 10-year benefit period and save some money. And so something you'll see on most disability insurance quotes is a chart somewhere, and you can see it here that says, hey, if my disability policy only lasts 3 years, 2 years, 5 years, 10 years, what happens to the premiums? And what you can see is that there's actually a benefit period to age 70 that Principal offers, which is just a little bit more. But let's say that we do a 90-day waiting period. And let's say Joe says, hey, I only want to pay for 5 years. Well, that would cut his premiums almost in half. Okay? So the shorter your benefit period is, it's very intuitive. It makes very easy sense, logical sense in my opinion, which insurance companies don't always do. The less expensive the coverage is. Now, for Joe in his example where, he's planning to work for 10 more years, I'm not sure doing less than 10 years of benefits makes sense for him personally, right? So that's where the plan comes in. You need to make these disability insurance decisions not in a vacuum, but integrated into a plan, and you need to match it to what your goals are. Now, the next question is, how much does it cost? Okay? This is impossible for me to tell you how much a disability quote would be for you, but you got 6 main keys. Okay? You got your age. Typically what's going to happen is the younger you are, the less expensive it is. But it gets a little interesting because the second key is benefit length. And if you're, say, 55, you're at about the highest chance to have a disability, but it would potentially pay you until you're 65, right? So 10 full years. Whereas if you are 62, you may have a higher chance than at 55, but it's only going to pay you for 5 years until you're 67. So your age plus how long your benefit period has a big impact, because for some people, a age 55 policy may actually be more expensive than an age 62 policy. However, that all kind of is a moot point. It makes a lot more sense to get it when you're less than 45. Okay? That's going to be something that if you are young, you're on this call, you're starting out on your own, and you are on your own, the buck kind of stops with you, right? You don't have any corporate insurance, and you need something to insure in the event that you're unable to work because you're not self-insured. So age and benefit length are the first two. The next one is health. This one's pretty straightforward. If you have health conditions, insurance will probably be a little more expensive. Gender, this one's interesting. On life insurance, men's life insurance is more expensive than women's. On disability insurance, it's the opposite. Women tend to live longer, and actually that makes the disability insurance a little more expensive for women than men. This one's also interesting, occupation, but it makes sense. If you're a lineman up in the trees, your disability insurance, if you can even get it, will be more expensive than in this example. We're using a lawyer, think accountant, think of the professional services firms that I typically work with. Those are typically ones where if you're making good money and you're sitting behind a desk, as long as you stand up your requisite a couple hours a day, you'll actually have better rates than other more active professions. And then finally, income. This relates to what I just said. There's a lot of data out there. For better or worse, right? That the more income you make, the less likely you are to, have a whole host of issues. And so the higher your income is, typically you get a better rate per thousand. Now, there's 2 other things to note here, and that is what type of premiums there are. And these terms are, dumb insurance terms. There's really no other way to say it. They're complicated and confusing, but there's 2 kinds, okay? There's what's called a guaranteed renewable disability insurance policy, and that means that they can't cancel the policy on you, but if the company does poorly, they could raise the rates, not just on you, but on the entire class. So every age 45 lawyer with an occupation 6A, if they raise the rates on you, they'd raise the rates on everyone. Okay, so that's option 1. The better option, the superior option, is what's called a non-cancelable policy. So not only can they not cancel the policy on you, they can't even raise the premiums on you. Okay? And let's look at that real quick. So if we go back to the quote, you'll see that, actually it's not written in here, but a principal policy is a non-cancelable policy. Something that you'll see is that some other companies will have an option where the base policy is guaranteed renewable, and for an extra couple $100 a year, you can upgrade to non-cancelable. So something to keep an eye on. And you can see here that Principal doesn't have an option, but that's because it's written in here that it's non-cancelable and has guaranteed premium rates to age 65. Okay, so there's no exceptions to them up through age 65 on them changing the policy on you. So if we're talking about what makes sense, you can see that really this is like the best of all worlds policy I did just for this example so you could see what's included. But this policy was $7,700 a year to insure $192,000 of benefits. Now the cost was 1.54% of income, and that is guaranteed not to increase because it is a non-cancelable insurance policy. Now, typically that is 1 to 3% of income. It'll land somewhere in there depending on your profession, occupation, age, all those things we talked about. But the main takeaway from this slide needs to be get it as early as you can because those health conditions can bite you. And then if you have a choice, get the non-cancelable. Just kind of guarantee that premium and you're not going to have to worry about it going up in the future. Now, with all of that being said, what I wanted to do is I always like to end these with an example, okay? Done a lot of talking, talked about the definitions, everything else, okay? Let's actually see what this looks like. Because remember when I told you that disability insurance should be part of a plan? Well, really, we just talked about disability insurance, okay? I want to show you what that means. So for our example today, we got Joe, male age 45. The only thing that would change for the women on this call is that the disability insurance would be a little bit more when we're looking at an example right now. But let's say either or, y'all are earning $500,000 a year, have your own law firm, your expenses are $100,000 per year, you're saving $200,000 per year, I haven't included any Social Security disability, and your investment account earns 6.4%, and disability unfortunately happens at age 47. Now, option one is we say, hey, pedal to the metal, I don't need disability insurance, I'm invincible, the stats don't matter, let's just save $200,000 a year. Let's get to where I want to go as fast as possible. Well, option two is the save but also protect your savings option, where instead of saving the full $200,000 a year, you pay a disability premium of $7,700, you save $192 and change, and you do get that disability benefit in the event that something happens. Now, what you'll see here is you're going to see my actual kind of planning module, Planning Center. Okay? This is just something that validates decisions, right? It's just something that says, hey, are we making a good decision with our money or not? Okay? I think inherently we kind of know, hey, if a disability happens, we're going to be in trouble, but it helps to see what those numbers look like. So, at the end of 10 years, if everything goes well, Joe Sample would have about $2.6 million. Maybe enough for him to retire on, if he wants to. It's pretty good. But if he doesn't have disability insurance and he does become disabled, the big trade-off is that he's going to run out of money by 2028. So it would take about 5 years for Joe to run out of money if he was unable to work and he needed to still spend that $100,000 of living expenses each year. Now, something I haven't even talked about is if you're disabled, there's a good chance your expenses may go up at the same time your income comes down. I haven't done any of that here, but let's say you need to modify your home. Let's say you need to get on a specialized health regimen, right? Well, not only is your income stopping, your expenses are going up. Okay, so that's something to also keep in mind. But you can see here that it's very intuitive, right? Hey, if he stays healthy, he's much better off not having the disability insurance. If he's unhealthy, or it could even be a car accident, right, or a work accident, he runs out of money in 2028. Now, let's look at what happens if you have disability insurance. Now, you can see that what I've done is I have said we're going to pay the disability premiums. That's great. But that's going to lower our savings account, right? So over 10 years, you can see that costs about $97,000 to Joe or Josephine. because not only do you lose the 7,700, you lose any of the investment earnings on that over a 10-year period, which sucks. But if we look at it, that's not a huge difference. Where the difference really becomes huge is if you become disabled. Okay? So you can see that rather than running out of money, Joe or Josephine still has almost $1.9 million in the event that that disability insurance kicks in at age 47 when they need it. So when we're talking about risks, when we're talking about planning, really the decision tree is, hey, do I just save all the money I can to get to where I want to go? Or hey, do I save a little bit of money, maybe spend a tiny bit more on protecting that income? And really, if we're looking at it, it's what, a 4% decrease in savings for the ability to insure about 75+% of that possible retirement fund in the event you're unable to work. So when we're talking about an example, let's go back to the presentation now. We're talking about something that is really a huge difference here. Okay? Something that we need to look at and consider. And actually, I'm sorry, it looks like I made a typo here. This first option is the protected option. The second option is the unprotected option. And then a misspelled occurs here. But what you can see is that the difference is minimal, in my opinion, versus the difference in the event that a disability does occur. Okay? It's going to be something where, in my opinion, it makes a lot of sense to review these options for yourself if you are married, for your family. Because really you're giving up a minimal amount to protect this. And if we look, 97,000 divided by 2.6 million, that's a less than 5% reduction in total savings for a huge cushion if something goes wrong. And like I mentioned earlier, kind of in passing, is that disability is 3 times as likely as death. And people tend to think about, in my opinion, death first because they're thinking about their family. Well, disability is a chance to kind of be a little bit greedy. Think about yourself, protect yourself, and it's also going to protect your family too. Okay? You do kind of owe it to yourself. Now, as far as if you're looking at disability, there's a few keys I want to share with you that I would consider looking at it, and this is how I've set up and structured my own policy. The first key is to actually do it. Okay, if you don't do it, you're always going to find an excuse to not do it, and then by the time something happens, you're going to say, damn, I wish I'd have done that when I thought about it. The first thing you need to consider after that, though, once you actually commit to do it, is you need to review those definitions in depth. You need to see if own occupation, if you can achieve that, and if the company you're looking at has a partial and residual disability rider. Okay, so make sure that you have that on there, because that's going to be key. One of the things you can do is actually, if you are working with an agent, you're gonna hate this, but ask them for their best quote. Okay, ask them for their best quote, have them send it to you, and rather than missing out on something, pare back a little bit if you need to, just so you know you're not missing anything. Okay. Now, premiums, I would go non-cancelable. Okay. And then benefit periods, I would match it to your plan. I typically start with just, hey, let's go through retirement. But if you only plan to work for 10 more years, do them for 10 more years. Okay? But let the plan lead your decision making. So if you have any questions, I'm happy to help you individually. Like I said, this is general educational. This is our November and December deep dive into DI to kind of get education out there for business owners and specifically professional service owners. My email is here, pgmoore@ironcladwm. I'm happy to help answer a onesie or twosie for free. Or if you would like to, strike up a relationship and work together, happy to do that too, if you like to schedule a time. Most importantly, if this is a good framework, a good rubric to help you on your own, more power to you. Good luck. And if anything comes up, I hope that we can help. So hope you all have a great rest of the day. I hope this was helpful, and good luck.